Pending home sales falling in June, down 0.8% from the month prior and 2.8% year over year, according to the National Association of Realtors. Still, realtors are optimistic that home buying and selling activity will pick up even as mortgage rates remain elevated. Joining me now on the latest data and the state of the housing market is Lawrence Yoon, National Association of Realtors chief economist. It's good to see you, Lawrence. So on the face of it, this does not look like a great number, this 0.8% decline. Can you talk us through some of the trends that we saw during the month?
Oh, well, you spent the past 12 months where home sales figures have barely budged. I know that in the latest month, we saw a slight decline, but then we had some increases in the earlier month. But essentially, over the past 12 months, no meaningful changes. And they're not meaningful changes because mortgage rates remain elevated. If the mortgage rate was to decline, we anticipate the buyers rushing into the market. But the high mortgage rate, even with more inventory on the market, is preventing buyers from signing those contracts.
Well, we all know where the mortgage rate stems from, right? It is benchmarked against interest rates set by the Federal Reserve, which happens to be concluding a two-day meeting today. And we're going to hear from Jay Powell later this afternoon. Can the housing market recover further without the Fed cutting rates?
Well, let's consider, we have had consistent job additions, over 7 million more jobs now compared to pre-COVID peak levels. So if we look at early 2020, right before the COVID arrival, now compare that with today, 7 million more Americans with jobs naturally means more housing demand. Yet home sales are running only 75% of pre-COVID. So what that means is that there's a sizable potential housing demand ready to hit the market, but the mortgage rate has to behave. And right now, the mortgage rate is not behaving. The Fed rate cut, whether it is later this year, but certainly as they normalize, Federal Reserve normalize, we are looking at about 6 to 8 rounds of rate cut, assuming that inflation numbers behave. So that will certainly induce more buyers to reach the market. We just hope that there's adequate supply to meet the potential demand from lower mortgage rates.
I do want to ask you about more supply in just a moment, but to linger on rates for a second, Lawrence. So let's assume that the Fed, when it does begin cutting, and we don't know when that's going to be, starts cutting by a quarter point each time. How many of those, or at what point do we need to get to really unleash that demand you're talking about in the market?
So when the Fed cuts interest rate, they're cutting their short-term bank interborrowing rates. It's not a mortgage rate. Nonetheless, market will evaluate all factors, things like national debt, what is the consumer price inflation expectations. And generally speaking, once inflation is close to 2%, and right now we are very close to that 2% inflation mark, and Fed cuts interest rate, mortgage rate will be declining with that, even ahead of the Fed in anticipation of it. So I think the Fed cutting rates by, say, 4 or 5 rounds, certainly over the next 12 months, a clear possibility that will bring mortgage rate down to around 6%. And I think the 6% will be the magic that really begins to revive the home sales market.
I guess you need a little more magic, though, in the form of more supply, to your earlier point, Lawrence. I mean, is there any sign that we are going to see that increase in supply, that we're going to see any kind of sea change in building, for example, or does the lower rate situation need to happen first to unlock that as well?
Well, our organization has been working with members of Congress bipartisan way to assure that the housing is the American dream. All the data points towards that ownership clearly provides the financial security, financial success over time. So we need to have that long-term supply vision. But in the short term, we do have some oversupply in some markets, Florida, Texas, from active home building. But those temporary oversupply can quickly turn into shortage once the buyers begin to reach the market. So we need to assure that things like any unnecessary regulation that hinders builders from going into the market, some zoning regulation that is too excessive, or even thinking about opening up some federal land near some major cities, just open up small slice so that more building can take place. So we need to consider long-term supply. Otherwise, home prices will keep reaching new highs. And even with the sales activity low, pending contracts low levels, we are still at a record high home prices, but we just want home prices to rise roughly in line with people's income growth.
Well, more and more home buyers are walking away from contracts, so what's driving the pullback? Here to break it all down is Yahoo Finance senior housing reporter Claire Boston. So Claire, let's start with the numbers here. How much have canceled sales actually increased?
Hi, Allie. So canceled sales are up about 1 percentage point from a year ago to about 15%. And if you look at those numbers compared to the really hot days of 2021, we are up from about 11% then to 15% now. So this is a pretty big rise, and it's interesting to look at June numbers too, because we see fewer cancellations typically in these kind of peak spring home buying season. But right now we're seeing a lot of buyers really willing to walk away.
And what's behind this trend? Why are more buyers backing out of some of these deals?
Yeah, so buyers right now, they have a lot of power in many markets. The housing market has shifted back in their favor. They have more inventory to choose from. And what we're really seeing is a lot of buyers will get to the negotiating table, and the deal will fall apart over things like inspection and repairs. You know, sellers may not want to pony up a bunch of money for, say, a new roof. Buyers will say, okay, if you're not going to do that, I will walk. I have other options to choose from.
And what about the sellers here? Why are some listing their homes only to just take them off the market?
Yeah, so we're seeing an uptick in delistings as well, and this is really the seller side of the same coin. In this housing market right now, we have so many sellers who have super low interest rates and high equity, and as a result, a lot of sellers are just kind of casual out there. They might be looking, you know, I have a price in mind, let me just list my home, see if I can hit it, but I don't have to sell. And you know, in this market, prices are falling in a lot of parts of the country. And as a result, you know, sellers who are not highly motivated will just say, if I can't get my dream price, I will just sit in this house and enjoy my 3% mortgage.
It's very true. And are you hearing anything from realtors or agents that can give more color to what's actually going on?
Yeah, I mean, I think the thing I hear from realtors right now is if you are a seller, now is probably the time to be realistic. The market has changed very quickly since interest rates have risen. And a lot of the realtors I was talking to were saying sellers may not realize this. So they may still be shooting for those 2021 prices. And you know, buyers right now, that's just not what they're willing to pay. And you know, if you don't price it right, your home might sit there.
Tough environment for sellers. Claire, thank you so much.
Thank you.
Appreciate it. You can scan the QR code below to see more housing content on the Yahoo Finance mortgage page.
We're taking a look at the names in the home builder space. Companies including DR Horton and PulteGroup reporting earnings on Tuesday, surprising analysts with solid earnings beats. We're navigating how to play the home builder sector with the Yahoo Finance playbook. And joining me now is Jay McCanless, Managing Director of Equity Research at Wedbush Securities. Jay, always good to see you, sir. So we did have a lot of news, a lot of data on that housing sector, Jay. We had earnings, we had new home sales, existing home sales. You, of course, Jay, know the home builder space so well. Maybe start broadly, Jay, high level. You look at the home builders as a sector, which you've covered a long time. You know, are you cautious, Jay? Are you constructive? How are you thinking about it?
Yep, and thanks for having me on. So I'd say on the builders that get most of their business from move up, these are people who are selling a home to buy a new home. We're still constructive on those names. I would put Pulte in that group, as well as Taylor Morrison, Pointe, and MHO, MI Homes. But we're a little more conservative, cautious on the entry-level sellers with names like DR Horton, as well as LGIH and some of the other names there. And I think it all comes down to confidence. You know, every builder this week talked about how the consumer, especially the low-end consumer, is just not very confident about their financial situation and what's going on with tariffs, et cetera. So until we see some improvement there and or some improvement in mortgage rates, which have basically been stuck at about 7% for over a year now, it's hard to see how things are going to get better on the low end.
Given the uncertainty there, Jay, you're kind of mentioning about the backdrop. Are builders changing at all what they're building, Jay? Are they sort of adjusting in terms of, you know, size and price?
Absolutely. So what we've seen is a couple things. The builders have dialed back on their housing starts until the consumer, I think feels a little more engaged, more ready to buy a home. But the other thing the builders have done where they can is bring the square footages down. That's the easiest way to solve for affordability is, take the bonus room off, do something like that, one less bathroom. But I think at some point we need to get some help on rates because I think the builders and especially some of the entry level names, Horton, Lennar, they've done about all they can do on shrinking the envelope. At this point, it's again need some rate help or need some help on the income side for consumers to get a little more income to be able to afford these homes.
Lou, I want to bring you here as well. Jay talked about rate help. I'm just looking at the 30-year fixed here, Lou. Mortgage News Daily, we're still at 6.81%.
Yeah, I mean, I look at the data here, and Jay, I'm curious your thoughts here. I look at it for existing home sales, and you see those mortgage rates, once they jumped above 5%, we just shifted into reverse and now neutral with those rates pinned up there, even new home sales. So you talked about a kind of a 911 for rate help. How much help do you think 25 basis points lends to the sector? Is it need to be more like 50 to 100 before you really see the impact, and how quickly could it help impact the progress in the sector?
Yeah, sure. So what the builders have told us is they are buying down mortgage rates generally to somewhere in the, call it 5.25 to 5.75 on a 30-year mortgage. So the faster we can get the actual base rate down to that level, that's when it helps. But if we were to go to the low sixes, high fives, again, I think that could help. But yeah, the 25 basis points we've seen versus last year, it's certainly heading the right way, but would like to see more. I think the other thing that builders have been doing is not only doing rate buy downs to make the homes more affordable, but they're trying to do things like adding some closing cost assistance where people are eligible for it, helping them apply for down payment assistance. There are multiple organizations that provide that now. So the builders doing everything they can without being able to move the rates, of course, beyond doing the buy downs. But yeah, we'd love to see something more like a 5 handle instead of the 6 handle where we are.
Jay, what is investor sentiment around the space and sector right now versus 6 months ago, 12 months ago?
I'd say it's been surprisingly positive. We had a lot of inbounds ahead of earnings season. You saw Horton have a very sharp upward move, I think 17% on Tuesday. People understand that there is a lack of housing in this country. They understand that the demographics and the population tailwinds are still there. It's just the consumer doesn't feel as confident this year as they did last year. So I think investors are kind of being picky and choosy about what they want to own right now. But I think, again, they realize the underlying demand trends are still pretty strong for the group. So it's just when's the right time to get in, right? So we think for the move up names now is a good time. And then when we get to later on in the fall and people start to think about spring 26, then maybe some of these entry level names will look a little more attractive then.
Jay, I'm curious, final question here. Given Trump's immigration policies, Jay, what, if anything, have you heard from the home builders about any kind of material impact to labor?
So I'll add the tariffs onto that as well. The tariff impact has been much less, I think, than the builders expected. Some of the builders had built in a little conservatism into their guidance, and they've rolled that off now. In terms of ICE raids affecting the ability to get homes built, it really hasn't panned out that way. I think if anything, the builders have talked about excess availability of labor, which is helping them get better rates to get the homes built and build them a little more quickly than they could have a year ago and especially 2 years ago.
Jay, always great to have you on the show. Thanks so much for joining us.
Thank you.